Thank you for joining us again on Wealth Plan TV. Today we're looking at risk once again, and Pina is with us again, Pina Sharoni, who's Head of Retail Distribution at AIA. Hi Pina, how are you going?
Good, how are you, Kerry?
I'm really well, thank you. Today we're going to see if we can focus on trauma and income protection.
Sure.
Can you give us a really brief explanation of what they are once again? If we do this often enough, people will say, hey, I need income protection, let me go out and get it.
So trauma insurance, or sometimes it's called crisis recovery, pays a lump sum amount of money in the event of a major trauma. So insurance companies would categorise major traumas as a heart attack or cancer or becoming paraplegic or something like that. So something fairly drastic. Income protection, on the other hand, protects insured if they become sick or have an accident whereby it takes them out of work for a period of time, and it pays a monthly benefit equivalent to approximately 75% of their monthly income.
And that can go on until they're 65 even.
They can go on until they're 65. With some insurance policies, they can go on until 70. Some of those income protection policies perhaps only cover you for 2 years, or others for 5 years. So there's different types of income protection policies that you can purchase depending on your circumstances and also depending on your affordability.
Okay, I think we spoke on the previous show of AIA Australia, which is one of, 10 or 12 major insurers in Australia, paying close to $450,000 last year in claims.
Yes, absolutely. So what that equates to is $1.7 million every working day, which is a considerable amount of money. And if you multiply that out by 11, which is the number of insurance companies out there in the Australian market, then that's quite a significant amount of money that's paid each day.
Yeah, $5 billion a year or more.
That's right.
Yeah,
that's right.
So the promise of insurance is paid. We said last time we met that really it's the contract which determines how things are paid.
That's absolutely true, Kerry. It is the contract that determines what the insured pays. So the insurance company will assess a claim based on what the contract says, based on the policy terms and conditions of that contract, and the definitions in that contract. So as an example, someone might be putting a claim through for cancer, and the contract will have particular definitions around cancer, around the severity of that cancer, for example, and hence will pay out accordingly.
So we're in an area here with income protection and trauma insurance, which has more variability.
Yes.
So life insurance is pretty simple. If you die or you're going to die, you're going to get paid.
That's right.
As long as there's a terminal illness benefit
that's
in
right.
the policy. With total and permanent disability, to paraphrase, if the insurance company's doctors say you'll never work again, you'll get paid. So those definitions are very, very universal.
That's right.
Although there are some variances, they're very minor. In the area of trauma insurance and income protection, there's great variety across the 11 or 12 insurance providers in Australia, and probably overseas as well.
Yes.
So how does somebody deal with that? We've got, let's start, say, with trauma insurance.
Yes.
How does somebody decide that 37 benefits are better than 34?
It's a very good question, Kerry, and it can be somewhat of a minefield out there in terms of the variations that are out there, and also having a look at what is the best product for that particular individual, whether they're male, whether they're female, whether they're younger, whether they're older, whether they've got a particular family history of particular illnesses or diseases. There's a lot of things that come into play. Affordability may come into play as well. It can be a bit of a landmine, and hence I would encourage the people that are watching this show, or anyone really, to go out and seek advice. Speak to an advisor about the best product for them.
Okay, income protection. Same sort of questions. The claims figures we've quoted already include income protection.
Yes.
I would imagine that income protection is the thing you pay on the most, I would think.
Yes, we do, Kerry. It's a very popular form of insurance, and also it's a form of insurance that perhaps as a young person, it's the first type of insurance that you would initially take out. So a person who comes out of university or starts earning an income, what we find is the first type of insurance that they look at is income protection. They're wanting to insure their income first and foremost.
Well, I guess that people are starting life wanting to start debt so they can buy stuff, and the problem with debt is that it can strangle you unless you've covered it.
That's right, absolutely right.
Okay, so income protection, we've sort of covered on various times before this that it's absolutely essential in both our views, truthfully. If you earn money, you need to protect it.
Yes.
The fact that you can't afford it is an even greater reason to protect it, because if you can't afford to pay for income protection, geez, you're in trouble.
It is so true,
Yeah.
and we see that so often, Kerry, is that is often the people that don't have income protection insurance because they can't afford it are the people that really need it.
Yes.
You know, if you think about it, you have bills to pay every day, you have a mortgage to pay, education, you know, whatever it is. If something happens to you and your income stops, you know, how do you pay for all those daily expenses? You know, what actually happens to you at the end of the day?
I remember I used to have a business card, and I'd write on the front of the business card, list all the people who'd pay your bills if you couldn't, on the back of the business card, and then I put PTO and put on the front of the card, I will. And I'd give it to people, and they'd say, what's this about? And really, I was making promises on behalf of the insurance companies that, you know, if you can't work for 6 months, mum and dad might help you along for a bit, but, you know, they've got to look after themselves as well, or sons and daughters might help you along for a bit, but hey, everyone is limited. You've got to look after yourself.
It's so true, and also, you know, there's some people think that if they're working for an employer, that the employer is going to take care of them, and yes, to a degree, the employer does through sick leave payment, but there's also, you know, sort of a restricted number of sick leave days that you can get from your employer. So once they expire, and if you still are ill, you may need an insurance company to assist you. You know, what concerns me is where we've got a number of self-employed people out there. You know, there's no one paying them, there's no one paying their sick leave, and yet we have a number of self-employed people that still don't have income protection insurance, and I think it's quite a concern.
Look, in all of my advice career, I never found one person who didn't need income protection, and he had 7 children. And he decided, well, we worked out that Social Security would pay him more than I could. So look, it is possible, but very, very rare.
Yes, I think so. I think that is very, very rare.
So, in relation to income protection, how would somebody actually get paid an income protection claim? What criteria must be met?
The main criteria is that the individual is no longer working due to accident or sickness.
Okay, and of course there's lots of different policy options that they can select at purchase, so waiting periods are an issue. So just briefly, a little about waiting periods.
Sure. So at the time of purchase, the individual will select, or their advisor may advise on, a particular waiting period. So it could be something like 14 days, 30 days is the usual, it could be 60 days, it could be 90 days. There are some policies out there that even have a 2-year waiting period. Typically though, as I said, it's normally a 30-day waiting period to an age 65 benefit is the normal policy.
So that's how long they'd have to wait before they could receive a payment?
That's right, that's right. So in effect what we're saying is the person has an accident today and it prevents them from working today. And it's got a 30-day waiting period. We will commence payments after that 30 days. However, in that 30 days, we're assessing the claim, obviously.
So, and of course, Pina, there's partial payments, but we won't go there. So, benefit period, that's how long you're going to get paid for. Can you tell us briefly?
That's right. So, if you have a to age 65 benefit period and you aren't working for that period of time, then you will be paid that monthly benefit for that period of time, right up to the age of 65.
Assuming you can't resume work.
Assuming you can't resume work for that period of time. So pretty much what we're saying is you will get paid until such time that you either return to work or age 65.
Yep. And the other, another definition in income protection is agreed or indemnity.
Yes, yes.
So agreed is an agreed payment at time of signing the contract. An indemnity is based on the income you earn at the time of claim.
That's absolutely right. So that's an important thing to note, and I would always advise to try and purchase an agreed value contract. So what we're saying there is that at the time that you purchase an insurance policy, we will assess your insurance benefit based on your income at that time. So therefore what that means is if you're earning a significant amount of income and you have an agreed value contract, but then at time of claim, for some reason, your income has reduced prior to that, we will still, absolutely, we will still go back to what was the income at the time that you purchased that policy, and that's what we need to pay you.
So let's just very briefly run over what we have. We have firstly the assumption and the assurance that the contract will be met under all conditions.
Yes.
The contract you've purchased is being negotiated with your understanding or through an advisor. And the conditions that you've had to have wade your way through are agreed or indemnity, what type of waiting period you require, what type of benefit period you require, and they're the simplest. There are many other benefits there. So it's almost impossible to make it simple. Can you give us can you help? How can we make this really simple?
Yeah, I think you're right, Kerry. It can get quite complicated. So I think that the consumer who is finding it difficult to wade through all the different variations and the different options should definitely be seeking advice, because through advice they'll get educated. First and foremost,
and they get educated on Wealth Plan TV.
They can get educated, absolutely. And then the particular advisor can also look at that individual's personal circumstances and provide the appropriate advice for that particular individual and their circumstances.
Sure. Well, thank you very much, Bina.
My
That's
pleasure.
Really good.
My pleasure, Kerry.
We'll hope we'll be seeing you again.
I hope you invite me again.
Thank you for joining us. As you can see, life is not as simple as we'd like to make it. In this area, I've said many times, seeking advice, it doesn't actually cost you, because the cost of the policy is the cost of the policy, and the insurance companies pay for the advice. But first of all, if you are seeking advice, make sure that the advisor will work for what the insurance companies pay. Ask a question on the website, and the best question each week will win a free risk assessment from AIA, which is really lovely. We'll see you after the break. Look forward to seeing you then.